$5,000 creates a very specific kind of tension. Spend it, and it feels wasteful. That is a meaningful sum of money, and you know you should be doing something smarter with it. Invest it, and it feels almost embarrassingly small. Every investing video you have ever watched talks about $100,000 portfolios and $1 million retirements, and $5,000 does not seem like it belongs in the same conversation. So, the money sits, parked in a savings account or tucked in a checking account, technically safe, theoretically waiting for a plan, but actually just being eroded by inflation every single month it does not move. That stuck feeling is more common than most people admit, and it is not caused by indecision. It is caused by not having a clear answer to the question that actually matters. What is this money supposed to do? Today I am going to give you that answer in the most concrete, actionable way I know how. I am going to walk you through exactly how I would invest $5,000 right now. Not what sounds good in theory, but what I would actually do with my own money. We will start with the two decisions that every investor should make before putting a single dollar into any fund, because getting those right makes every choice after them obvious. Then I will show you the portfolio structure, 3 buckets, 3 clear jobs, 3 ETFs, how I would split the $5,000 across them, and why each piece earns its place. And at the end I will show you the 30-year projection from that single one-time $5,000 investment. The number at year 30 is over $367,000, not from adding more money every month, just from letting compounding and time do the work on $5,000. $5,000 is not an insignificant amount of money to invest. It is just an amount that requires understanding the math of time rather than the math of size. Let me show you what I mean. Before we look at any specific funds, I want to spend time on 2 decisions that almost every investing video skips entirely. Most content goes straight to the asset. Here's the ETF, here are the numbers, here is the projected return. But the reason people end up with portfolios they cannot actually hold through difficult periods is almost never a bad fund selection. It is a mismatch between what the portfolio is designed to do and what the investor actually needed it to do. Getting these 2 decisions right before choosing a single fund makes everything that follows coherent. Skipping them means building on an unstable foundation. The first decision is defining the job. Money can do several different things inside a portfolio, but in investing it generally comes down to 3 primary roles. The first is growth. The money's primary task is to become meaningfully larger over time through price appreciation. The account balance will fluctuate significantly from year to year. Some years it will feel like the best decision you ever made. Others will feel deeply uncomfortable. Income is not the focus here, and consistency of experience is not either. Growth portfolios trade psychological smoothness for higher expected long-term compounding. The second role is income. The money's primary task is to generate regular, spendable cash flow. Dividends arrive on schedule. The experience feels more stable. The account does not swing as dramatically, and there is tangible evidence the investment is working in the form of distributions hitting your account. The trade-off is slower overall growth because income-focused funds typically own slower-growing, more conservative businesses. The third role is flexibility. The money's purpose is to remain accessible and optionable. Liquid capital that can be deployed when opportunities arise, used as a buffer during emergencies, or redeployed as circumstances change. Flexible money protects you and gives you choices. It does not compound nearly as effectively as the other 2 approaches. These roles are not ranked in order of value. All 3 are legitimate depending on what an investor genuinely needs. The problem is mixing them up. Wanting your growth portfolio to feel like an income portfolio during a correction, or wanting your income portfolio to keep pace with a pure growth portfolio during a tech bull market. The confusion between what you designed a portfolio to do and what you wish it would do is the source of most bad investing decisions. So for this portfolio, I am choosing the role deliberately and upfront. This $5,000 is growth money. It is not emergency capital, and it is not money needed in the next several years. Time is the primary advantage here, and when time is genuinely on your side, a horizon of 20, 30 years, growth historically does more compounding work than any other approach. That choice has clear implications for what the portfolio looks like and how it will feel to hold it, which leads directly to the second decision: pain tolerance. And I do not mean the abstract version, I mean the specific, dollar-denominated, sit-with-it-for-weeks version of the question. A 20% drawdown on $5,000 means watching $1,000 disappear from your account on paper. A 30% drawdown means $1,500 gone, not permanently, but gone on screen, on your app, in the number your eye goes to every time you check in. For a growth-heavy portfolio focused on technology, those drawdowns are not exceptional events, they are features of the asset class. In 2022, the technology sector fell roughly 33%. VGT, one of the funds we will discuss today, lost approximately 29 to 30% of its value in a single year before recovering strongly in 2023. Investors who held through that experience were ultimately rewarded. Investors who sold near the bottom, who discovered in the middle of the drawdown that their actual pain tolerance was lower than their stated pain tolerance, crystallized a loss and missed the recovery. Before you build a growth portfolio, you need to be genuinely honest with yourself about which investor you would have been in 2022. There is no judgment attached to either answer, but the answer should determine how you build. With those two decisions made, growth as the goal, pain tolerance acknowledged, the portfolio structure becomes almost obvious. You are not asking what is popular right now or what performed best last year. You are asking a much more useful question. What tools help a growth-focused portfolio survive long enough to compound? Survival is not a dramatic word in this context. It is a literal description of what separates investors who end up with the projected 30-year outcome and investors who exit the portfolio at exactly the wrong moment because it became psychologically unbearable to hold. Building a portfolio that is not just theoretically optimized, but genuinely holdable through difficult markets is the real challenge. That is what the three-bucket structure is designed to solve. The portfolio I would build for this $5,000 has three buckets. Each one has a specific, non-overlapping job. None of them is trying to do everything at once, because funds that try to do everything at once typically do nothing particularly well. Let me walk through each bucket individually before showing you how they combine. The first bucket is the growth engine. This is where the aggressive long-term compounding comes from. In this portfolio, that role is filled by VGT, the Vanguard Information Technology ETF. VGT owns U.S. technology companies across the full range of the sector: software, hardware, semiconductors, cloud infrastructure, enterprise technology. Apple and Nvidia together account for approximately 35 to 40% of the fund. Microsoft adds another substantial weight. The top 10 holdings represent roughly 54% of the total fund. The expense ratio is 0.10%. The concentration is intentional, and it is the source of both VGT's exceptional growth and its exceptional volatility. When technology leads, VGT leads hard. When technology sells off, VGT sells off hard. The numbers behind VGT's growth case are genuinely compelling. Over the last decade, VGT has delivered an average annual total return of approximately 20 to 22%, one of the strongest long-term records of any broad ETF in existence. In 2023 alone, following the brutal 2022 correction, VGT returned approximately 52%. In 2024, it returned approximately 29%. In 2025, it returned approximately 21%. The consistent driver of these returns is that the largest technology companies in the world, the Apples, Microsofts, and Nvidias, have grown their earnings at rates that justify and in many cases exceed their share price appreciation. These are businesses with enormous and growing revenue, high margins, global distribution, and structural tailwinds from AI, cloud computing, and automation that have years of runway remaining. The dividend yield on VGT is approximately 0.40%, essentially negligible. Almost all of the return comes from price appreciation. This is not a fund for investors who need income. It is a fund for investors who want their capital to grow as aggressively as the technology sector can deliver over a long period. The second bucket is the global backup. Growth does not only happen in the United States, and no single market gets to dominate forever. The 15-year period of U.S. outperformance we have just lived through is extraordinary by historical standards, not normal. This bucket is filled by VXUS, the Vanguard Total International Stock ETF, which gives you exposure to thousands of companies across Europe, Asia, Latin America, and other developed and emerging markets worldwide. Nestlé, ASML, Toyota, Samsung, Roche, HSBC. These are world-class businesses that simply happen to not be listed in the U.S. VXUS serves two distinct purposes in this portfolio. The first is genuine geographic diversification. If U.S. technology experiences a prolonged period of underperformance, as it has during other historical cycles, VXUS ensures your entire financial future is not dependent on one market and one economic trajectory. The second purpose is income diversification. VXUS currently yields approximately 2.9 to 3% in dividends, meaningfully higher than VGT's near zero yield, with dividend growth that has averaged approximately 6 to 7% per year. That income stream, even though it is not this portfolio's primary objective, reinvests automatically and contributes to the total compounding story over time. VXUS's price appreciation has historically been more modest than U.S. technology, mid-single digits annually over the long term, but its behavior across market cycles differs enough from VGT that owning both provides genuine diversification rather than just the appearance of it. The third bucket is the shock absorber. And this is the allocation that most growth investors skip and then discover in the middle of a difficult market that they needed it. This bucket is filled by GLD, the SPDR Gold Shares ETF, which gives you direct exposure to physical gold. GLD owns actual gold bullion held in secured vaults, and its price moves with the gold price. The expense ratio is 0.40%. Gold does not pay dividends. It does not produce earnings. It does not grow in the way businesses grow. Its investment value comes from one specific property. It tends to behave differently from equities when confidence in the financial system and in risk assets comes under pressure. When stock markets sell off sharply, when inflation erodes purchasing power, when geopolitical risk elevates, when currency values come under pressure, gold historically holds its value or rises as investors seek something that is nobody's liability and no government can print more of. Over the last decade, gold has delivered approximately 13 to 16% average annual returns, a period that included the COVID crash, the 2022 inflation shock, and significant geopolitical turbulence. For projections in this portfolio, I am using a more conservative 8 to 10% long-term assumption for gold, which more closely reflects its full historical average across multiple decades rather than the exceptional recent window. Gold does not compound smoothly. It moves in bursts, long flat or declining periods followed by sharp upward moves, usually when other assets are struggling. That is precisely the property that makes it valuable in a portfolio context. When VGT is down 30%, the probability that GLD is up significantly is meaningfully higher than for almost any other asset. That non-correlation is what gives the portfolio stability during the periods when stability is hardest to maintain. The allocation across these three buckets is where the growth orientation of the portfolio becomes concrete. Out of the full $5,000, 50%, $2,500, goes into VGT. This is the engine. This is the piece doing the aggressive long-term compounding. At 50% of the portfolio, VGT has enough weight to drive meaningful overall returns when technology performs well, which over long periods it has done more consistently than almost any other sector. The 50% allocation is not reckless. It is proportional to the growth goal, but it does mean that when VGT has a difficult year, which it will, the portfolio will feel it. That is the cost of buying what you actually want from this allocation. 30%, $1,500, goes into VXUS. The international backup is sized large enough to provide genuine diversification and to contribute meaningfully to total return over decades, but not so large that it dilutes the technology growth thesis that is the core of this portfolio. VXUS at 30% gives you broad global exposure, a meaningful income stream that compounds through reinvestment, and a behavioral cushion. International stocks often move on different cycles than U.S. technology, which means some years when VGT is struggling, VXUS is quietly doing reasonable work. The remaining 20%, $1,000, goes into GLD. This is the shock absorber allocation, and it is the piece most people push back on. Gold in a growth portfolio feels counterintuitive. It does not pay anything. It does not compound in the traditional sense. In a strong bull market for U.S. technology, that 20% of the portfolio sitting in gold will look like dead weight. But its purpose is not to maximize returns during good years. Its purpose is to change the portfolio's behavior during bad years, to reduce the drawdown severity enough that holding becomes psychologically manageable when VGT is having one of its 25 to 30% corrections. An investor who holds through those corrections with GLD providing partial offset will significantly outperform an investor who sells near the bottom without it, even if the long-term return on gold itself is lower than the equity positions. Building a portfolio you can actually hold is more important than building the theoretically optimal portfolio you cannot. When you combine all three positions into a single portfolio view, the metrics tell you precisely what kind of experience to expect. The combined dividend yield is just over 1%. This is an immediate and honest signal. This is not an income portfolio. If regular cash payouts are what you need from this $5,000, this is not the right structure, and you should know that clearly before putting money in. The combined dividend growth rate is approximately 2 to 3% annually, steady but modest, again reflecting the growth rather than income orientation. The combined price appreciation across all three positions, using historical return rates weighted by the 50-30-20 allocation, averages approximately 15% per year. That 15% blended return is the engine that produces the 30-year projection. Here are the numbers. Starting from a single one-time investment of $5,000, no additional contributions, just compounding from the initial amount, with dividends automatically reinvested. After 1 year, the portfolio is projected to grow to approximately $5,800. That first-year number is modest. It is not designed to be exciting. The power of this portfolio is not in its first year, it is in what time does to the math over very long periods. After 10 years, the projected value is approximately $21,600. The original $5,000 has grown to more than 4 times its starting value purely from compounding. After 20 years, the projection reaches approximately $89,600. This is where time starts to become visibly powerful. The gains are now coming faster in absolute dollar terms than the total amount you started with. And after 30 years, the projected value is approximately $367,000. More than 70 times the original $5,000 investment. The composition of that $367,000 is worth understanding clearly because it reveals exactly how this portfolio works and does not work. Of the roughly $362,000 total gain over 30 years, approximately $360,000 comes from capital appreciation and approximately $2,000 comes from reinvested dividends. The income contribution is essentially negligible. By year 30, the annual dividend from this portfolio is projected at approximately $78, which works out to about $6.50 per month. That is not a failure of the portfolio. It is the trade-off working exactly as designed. You chose growth over income at the outset. The portfolio delivered growth over income across every one of the 30 years that followed. If after 30 years you want income, you convert, sell a portion of the $367,000 and redeploy it into income-generating funds. But the $367,000 asset base you are converting from is the payoff for 3 decades of accepting the growth trade-off consistently. The 15% blended average annual return assumption is an honest one to examine because it drives all of the projection numbers and it is not guaranteed. VGT has delivered approximately 20 to 22% annually over the past decade, but technology does not outperform by that margin in every decade. The 1990s saw similar tech leadership followed by the dot-com crash and a decade of underperformance in the 2000s. The blended 15% includes a conservative gold assumption and the moderating effect of VXUS's lower historical growth rate, which brings the overall portfolio return below VGT's exceptional recent average. Over a genuine 30-year horizon, there will be multiple extended periods where this portfolio underperforms a simpler S&P 500 fund, and multiple extended periods where it significantly outperforms. The 30-year projection smooths those cycles into an average. The investor who achieves something close to that average is the one who stayed invested through all of them without abandoning the structure at the bottom of the worst ones. $5,000 is not too small to matter. The math of compounding does not care about the absolute size of the starting amount. It cares about the rate of growth and the length of time. $5,000 at 15% annually for 30 years produces $367,000 through the exact same mechanism that $500,000 at 15% annually for 30 years produces $36.7 million. The proportion is identical. The only variable that changes the absolute outcome is the starting number, which means the most important thing you can do with $5,000 today is not find a slightly better ETF or a slightly more optimized allocation. It is to start, to make the decisions deliberately. What is the job? What is the pain tolerance? Build the structure that matches those answers, and then give it the one input that cannot be purchased or shortcut: time. If this framework helped you think more clearly about your own approach, hit the like button and subscribe. I release new content on portfolio construction, ETF strategy, and long-term wealth building regularly. Drop a comment below and tell me how you are thinking about your own $5,000 decision. Whether it is the same amount or different, the framework applies. I read every single comment. I will see you in the next one. I